Hey everyone, it's Mike from Order Flows, and welcome back to the Strategic Order Flow Trading course. This is Module 2 on enhancing your order flow trading performance. All right, so, a footprint is a tool that fits within the spectrum of trading tools. I'd compare it to technological advances, highlighting how tools evolve over time to become more efficient and effective, right? The tool, the footprint, I would rank alongside other tools like Bookmaps and price ladders, which represent the latest advancements in trading technology. People that are newer to trading in the last 10 years don't realize how far technology has really come. When I was getting started in trading back in the late 80s, early 90s, personal computers were already kind of mainstream already in the house, but the charting really lacked good visuals. And, over time, it's really had big technological advancements. So, we should be happy. We're living in a time of great, information and knowledge that's available to traders. So setting up a footprint chart requires customization based on your own individual trading strategies and preferences. Now, here are some key considerations. The time frame. Choose a time frame that aligns with your trading strategy. Shorter time frames provide more detailed information because you're looking at it on a very short time frame, while longer time frames offer a more broader perspective of the market in general. So, as a trader, we all have sort of the sweet spot that, we're going to fall into on how we analyze the market. Some people like to watch markets move over time. Some people like to watch markets move based on price movements. Some like to watch it based off of, volume or the amount of trades. So there's many different ways to look at it. You got to find which one works for you. I can't say you have to look at a market this way. You have to look at a market based off of a 1 minute chart, right? That'd be a big disservice to you. Because, at the end of the day, it might not suit you in terms of risk profiles. Okay. So you got to find what you're going to, what works best for you as an individual. You also want to think about the types of rotations, right? Rotations, is based on time or specific price movements, e.g. point and figure, ranges, a range-based chart. A lot of the original order flow traders love to use sort of a point and figure reversal chart back in, the late 2000s, early, 2010, 2011, 2012. So you're going to select the rotation that best suits your trading approach. All markets have rotations. S&Ps, it's about a 3.5 point rotation. If that's the type that you want to do it, otherwise, you use a time-based chart. You got to also think about the statistics that you're going to look at, right? Statistics provide summaries of volume, delta, cumulative delta, price changes, etc., max, min, delta. And these statistics help traders analyze the market activity more efficiently, right? I mean, it's amazing the amount of information now that's available to a trader. And again, I don't want to, keep beating a dead horse, so to speak, but, back in the early days, if you're an off-the-floor trader, if you could call someone on the floor, get some color, of the market activity, you're special, right? You had a special connection or you had a big account or something. But, now you can see, how much volume trades specifically at each price, whether, how it was traded, on the bid or on the offer and all sorts of things. Whereas before you're just looking at, the price that traded. Okay. So again, we're living in a great age of trading information. Now, again, you have to put on your chart what you need to be successful, right? This is your normal basic footprint chart with, on a time-based chart, you got your delta, your volume, the max delta, the min delta, cumulative delta, volume. You can see in the bar itself, and you can see the point of control. You can see the buying imbalances and selling imbalances. Now, there's software like my Order Flows Trader software where you could take it a step further. You can see the value areas. You can see areas where price was exhausted. You can see areas of thin volume in the bars. You can see areas where the market ran away from. And there's just so much information you could put on. But don't overwhelm your chart that makes it very messy. Again, just put on what you need to see to be successful. Okay, so the next part is what is the best time of the day to trade, right? Because, when for 20 years, I would go to the market before it opened all day until it closed, and even after it closed, and then, catch the reopens and stuff. But, our body, we have sort of this optimal time of focus. Okay. So, I like to break down the trading day into, different time periods, so to speak. You have your opening range, right? And during that opening range, there's a surge of orders, batched up from overnight, then released right at the open, right? This influx of orders can provide good movement and liquidity to read the market's directional bias. This is what I refer to basically as the cash open. And however long you want to decide, there's opening range. It could be the first minute, it could be the first 5 minutes, the initial balance, the first hour. Those are, that's a time when you've got a lot of liquidity in the market, and the markets can make directional moves during that time. Then there's sort of the morning period, right? This is after, the open. And, you're going to see active trading, providing opportunities to fade the overnight sentiment. People like to trade initial balance breakouts or initial balance, the range, et cetera. And, they're going to look for reversals back from the prior's close, if there's gaps, et cetera. And you can also see trend days develop during this period. It's probably the most active time, not the highest volume necessarily, that traders are in front of their screens. Okay, this is probably the time where you get the most amount of traders, because you have the New York open, and it's overlapped with sort of the European close. I mean, European close is around 10:30 Chicago time. So, there's a good 2 hours where you have traders in Europe as well as traders in the US actively trading the market. So it's a pretty active time. That's probably one of the better times of the day to trade. Now, the cash open, again, you're going to get a lot of volatility coming into the market, right? Right here is the cash opening bar. Obviously, this market, you had a nice move, 44.28 all the way up to 36. But it's a big move. Why? Because everybody and their brother on the institutional level is waiting for the cash market to open to start trading. So their orders are basically queued up in the system to start executing right on the cash open. It's not like they're sitting around and waiting for the 8:30 to start typing in stuff. No, you got the execution algos. You put a time limit on it. Okay, starting at 8:30, buy me 500 E-minis. Okay, or buy me 500 over the first 5 minutes, or buy me 5,000 over the first 15 minutes, breaking it up however type of execution algo they want to use. So that's why you get those big volume spikes, because all the orders just been waiting for that time, because that's the most liquid time that traders are going to have to trade until the close. Okay, but I'm going to talk about the close a little bit later. So then you got your, after your morning, then you run into lunch. All right, you're going to get lower intraday volatility from sort of the 11 a.m. Central Time to 1 p.m. Central Time. And offers chances to monitor order flow, dryness, and prepare for the afternoon. What I mean by dryness is lack of liquidity. It's a good time to step away from the PC, so to speak. But again, don't think that just because it's lunchtime, there's nothing going on, because moves happen all the time. Then you sort of have that afternoon trend period, right? Sort of the 1 p.m. to 2 p.m. Again, Chicago time. I don't want people getting confused. I better write that in there. Chicago. 'Cause Chicago time. Oops. Okay. And sometimes, intraday trends emerge as institutionals start position for the close. If you're going to trade that time, join the directional order flow in this period and ride the momentum. This is the Fed zone, right? The Fed likes to come out around 1 p.m. Central Time and make their announcement, right? That's their scheduled announcement period. I don't understand why they make their announcement, then do a press conference afterwards. They're just reading a statement anyway, so might as well just start it at 1 p.m. But anyway, then you run into the closing hour, and that final hour sees another spike in volume and volatility as day traders square their positions and institutions complete their rebalancing. Sometimes these big institutions got to target the market closing price, so that's their benchmark, so to speak, is the closing price. And that's why you see a lot of volume go through. So active order flow reveals the market's last minute conviction into the close. However, cash close is the final, right? That's it. It's over. even though the futures are still open for another basically hour. And again, these bookend periods of market open and close provide surges in activity and order flow interaction to best read market conditions. The midday period presents opportunities as well, but as an adaptive trader, you can optimize order flow trading across different intraday periods, right? You just got to understand there's going to be busy times and there's going to be slow times. It's not consistent throughout the trading day. There's lulls, right? I mean, people go out to lunch. Liquidity is removed from the market because traders aren't sitting in front of their screen. So for example, right, the cash close, you get good movement, right? 42,000 contracts trade, and then it flatlines oftentimes. I mean, you can see it's for the next few minutes. Sometimes you get a little bit of continuation, but oftentimes it just flatlines. 42,000 on the cash close versus 11,000. So the cash close has the most volume, but once that volume is spit out, then market activity is pretty much over with. I mean, big traders have closed their books for the day. So by identifying areas with the maximum trading activity, traders can gain insights into market sentiment and behavior. So moreover, it's essential to observe how the price responds after significant trading activity occurs. What happens on the cash close, on the cash open can give you direction. What happens on the cash close is sort of a different thing. People are, when cash opens, people are sort of positioning themselves for the trading day. When the cash closes, they're sort of marking it to book value, so to speak. So another thing to look for is delta. Okay, delta change is the most important aspect to look at in terms of delta, right? Don't just think, oh, this bar's got this delta, this bar's got that. Look at the change relative to previous bars. Right, that's going to provide valuable information on market trends. The delta change from the previous bar can indicate potential market reversals. So for example, delta change. Now, in this case, you can see delta is getting a little bit weaker here. I mean, as we're coming down, minus 30, minus 315, then small positives, then small negatives, strong negative, and then, small positive 30, 19, 323, negative 22, plus 200, plus 200, as the market starts reversing. But again, you're not just taking, it's plus 200. You're taking it's plus 200 to minus 22 to plus 323. So it went from 30 to 19. It was about equal. Again, I'm not going to say, it dropped down. The delta went down from 30 to 19. Oh, it's still positive. Then obviously it grew bigger. So you're watching how the delta change over several bars, not just the bar itself. Okay. Here, right? Sort of came down, strong negative delta right at this swing low. Then you got negative delta minus 700. It's a green candle. Okay, why do I got negative delta? It's because I got 1,000 here. So I got some absorption coming in here. Okay, so I got a sign of absorption. Then I got strong aggressive buying coming in with positive 1,500 delta. Okay, so again, just because you have a negative delta, look at what's happening in the bar. Right, you see I got a green candle, right, with negative delta. That means something. Then you got to start trading it effectively. So you got the delta sort of coming in here, negative, big. Still, you can say it's negative, but it's a lot weaker negative than over here. Minus 151 is still a green candle. So you got two green candles with negative delta, followed by positive, big positive, 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 big positive. But again, you're not just saying that it's big positive, you're comparing it to all the deltas, right? You take more of a snapshot as opposed to just focusing on the one bar's delta itself. 435, obviously bigger than 75. It's obviously much bigger than minus 151. Now, extreme delta spikes tend to be unsustainable. And increasing delta signals momentum is accelerating in that direction as aggressive traders pile in. So focus on the rate of change in delta. Sharp rises suggest urgency and conviction. Slower delta, change that to slower delta increases equal less commitment. Net delta needs to expand and refresh to drive sustainable trends, not just spike. And what do I mean? Extreme delta, right? This is a market, right? Big negative delta, minus 3,400, minus 3,300. But it's consistently negative, minus 700, minus 5, okay, that's nothing. But minus 278, minus 431, minus 1,000. You still have that selling. Coming in here as the market keeps going down, right? If you don't get that consistency, no follow through here, minus 2,600, then what? Minus 200. Positive, positive, small negative, a negative, and positive, positive, small negative, a negative, and positive, positive. There's no consistency on what's going through the market here, right? As the market went back up. Delta momentum involves analyzing consecutive bars with consistent positive or negative deltas, right? These consecutive bars indicate strong order flow in a particular direction, further confirming the prevailing trend. Traders can use delta momentum to focus exclusively on long or short trades based on the overall direction of the order flow. Delta momentum, right? It's still there, right? Even though you got some positive deltas, they're still relatively small. The momentum in terms of delta is negative, minus 103, minus 154, minus 400, minus 300, minus 400, minus 400, minus 900, minus 300, right? That's what you want to see as the market keeps going down. Now, the max delta indicates the price where the most aggressive buying occurred. The min delta shows where intense selling pressure stepped in. So max and min delta, the importance, just really quick, because it's important to note. Zero max delta, right? This is the max delta here. So that's basically telling me that, at this point, aggressive buyers were not in control. It doesn't mean that there were no aggressive buyers. It's telling me that at no point were the aggressive buyers in control. And when I start seeing them, sort of coming in consecutively, like here, you got minus 1, minus 5, minus 1. Okay, I'd be looking for this market to go up. It just sort of went sideways. Now it starts trending down. Now I see aggressive, the max delta being 0 and 0 is telling me that aggressive buyers weren't in control here, and I'd be looking for the market to, continue on down. So watch when you're seeing max and min deltas sort of coming in weak consecutively or relatively consecutive. Again, what's the max and min delta doing? As the market is trending, you should be paying attention to this information, right? Minus 1, 0, minus 20. It doesn't have to necessarily be 0 or minus 1 or minus 2, minus 3. As long as it's small, right? Minus 20, minus 100. Final delta is strong, 800, 800, 200, 400. That's important information that is telling you that, because generally in a bar, you're going to have some, aggressive buyers, you're going to have aggressive sellers, and it's a battle, right? And sometimes, sometimes one side is going to be winning, sometimes the other. But when you have, relatively small max min deltas, it's telling you that one side never had control, or if they had control for a very brief moment, right? And that's useful information. Now, delta at price. The benefits of using delta at price in order flow analysis is it helps identify imbalances between buying and selling pressure. By looking at the delta, which is the rate of change in buy or sell order flow at different price levels, you can see where there is more aggressive buying or selling happening. A large positive delta indicates buying pressure, while a large negative delta indicates selling pressure, right? We know that, okay? But when you look at it on a price level, right, it gives you another insight into the market. It reveals support and resistance levels. Price levels with consistently high positive or negative delta can act as support or resistance, representing areas where buyers or sellers are more active. And watching how delta evolves at key prices gives clues about the strength of these support and resistance zones. So delta helps gauge the conviction behind moves. Large, rapid delta spikes show strong conviction behind buying or selling at certain price levels, versus slow, steady delta changes which reflect less urgency. So this can aid in assessing how meaningful price move is. So it acts as an early indicator of potential breakouts or reversals. Shifts in delta often precede price breakouts and reversals, providing an early warning of change. If delta starts dropping at support, it flags breakdown of risk, or vice versa for resistance. Now, sort of getting back to delta at price, it gives a more accurate representation of buying and selling pressure. Delta at price looks at the net delta of orders at each price level rather than just the number of orders, right, or the volume. This gives a better sense of true buying or selling pressures. Larger orders have a higher impact on delta. It's going to identify support and resistance levels. Price levels with high net positive or negative delta can act as support or resistance, since it shows where substantial buying or selling interest exists. Watching how delta evolves at key prices is helpful for trading. So, for example, delta at price, right? Most footprint charts, you can do this, right? It's a setting on there. And when you're watching delta at price, okay, you're going to be watching where the heavy deltas come in. Are they coming in at the bid or the offer? Is it a green candle? If it's a green candle and I'm seeing, heavy volume coming in on the bid, that means something, right? That means support in the market, right? Heavy volume here, minus 438. So I know at this price level, there's some strong support coming into the market right here. Right? I can see it again here showing, one tick. The next tick higher, minus 571. It's the heaviest volume in delta at price in this bar. Minus 340 here, minus 398. So I know there's some strong bids coming into the market to absorb whatever aggressive selling is taking place. And if I see that sort of being sustained here, 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 then I know that, there's a bid in this market offering support to this market, that the market should keep going higher. Right? Just as if a market is going down, I want to be watching where is the heavy volumes coming in. Like here, I got minus 252. Okay, but here I got minus 239, minus 203, minus 214. Look at this big, decent sized bar. But I don't see the bids coming in here getting whacked. Instead, what I see is offers coming in here, offering resistance to this move from going any higher. Right here, minus 330. It's 333. So that's the heaviest offer coming in here in this bar, heaviest volume, and it's on the offer side here, 600. Right, so you'd be looking for these areas where there's the heavy volume coming in on either the bid or the offer side on the delta at price bars. Okay, so when you observe a market rally followed by a generation of support levels, this indicates a trending market moving higher. However, when the support levels start transforming into resistance, it suggests the market's upward momentum may be diminishing. So, for example, right here, we got this move going up, right? I see some decent bids coming in here, right? 465, 254, 306, okay? Minus 119 right here. So I know that I got some support in this market. Okay, market keeps going up, again, another decent size support here, 319. Market goes up, starts going sideways, and it's coming down. Right? This area here, which was my support on the way up, is going to become my resistance. You can see it's just, if I could draw a line on this. Try this, right? So, right, I got this area here. Right? You can see, look at this. This is where my heavy bids were. Now it's becoming my resistance here. Okay? And the market went down. Right? We hit it, we bounced back again, we trade back in it, and we went up, ran into some resistance up here, sort of which coincides with this level here. Right in here. Traded back into that area. This was your support. This was your support. Now it's becoming resistance. Trade below, come back up, hits resistance, goes back down. Okay. Now, the importance of order flow imbalance and its location in a footprint chart is that it provides valuable insights into supply and demand dynamics at a given price level. Imbalances can confirm or negate breakouts. Heavy buying or selling imbalances during a breakout increase chances it will be sustained. Lack of imbalance shows lack of conviction. Traders can quantify the energy exerted during a price move and gain valuable insights into market activity. The ability to witness volume development vertically rather than just horizontally offers traders a more comprehensive understanding of market dynamics. So imbalance changes show shifts in control. Flipping from selling to buying imbalances at a price level indicate a shift in control and increased likelihood prices will move up through that level. The opposite for flipping from buying to selling imbalances. Here you got your buying imbalance, and it's flipped with selling imbalance. Market goes down. Here you got your selling imbalance, and it's flipped with the buying imbalance. Although this is a green candle, but still, right? It's still acting as support. Then you got the aggressive buying coming in, and market goes up. This is the imbalance flip, right? Occurring at the same level. And, it's interesting because when you watch imbalances coming into the market, where they come in relative to other imbalances, it gives you some insight into the market that not a lot of people have utilized in their trading. So the location of imbalance relative to the current price also indicates who has control. Imbalance below current price signal buyers are in control, while imbalance above suggests sellers are driving price action. But let me just further expand this. Imbalance, I'm going to fix this here. Can't do that there. Just bear with me here. Close this down. But what I wanted to get at was imbalance below, well, who has control? So in green candles, right? In green candles. Imbalance below current price, because price is trading above the green candle, while in red candles, imbalance above price, imbalances that come in above suggest sellers are driving price action. I'll just show you on the chart. It's a little bit easier. Price relative to the imbalances. Where is price trading relative to the imbalance in this bar? It's trading at the bottom. It's trading below price. Right? It's trading below price. Price is trading above the buying imbalance. Price is trading above the buying imbalance. That's what you like to see. Right? You don't want to see the bars where you sort of get the imbalance, sort of up near the top of the green candle and price is trading below it, right? You want to see that continuation happening in the market, right? That is a healthy market. That's an efficient market, not one where you have the imbalance sort of trading. Let's just sort of go back a little bit here. Where, let me find a good example, something like this, right? This is not healthy, right? That's why you see the next bar doesn't go anywhere, right? It needs to correct itself, which it finally does. So you're looking for, like this green candle, right? You got the selling imbalance, okay, but that's support in the market. We're trading below it, okay? So watch where it appears in the bar relative to price. Now, imbalance levels that persist over time or receive additional orders are seen as more significant. The stronger the conviction, the more important that price zone. So, for example, imbalances at the same levels. Boom, boom. It's continuing. Buying imbalances at the same levels here. Those are strong. So it's telling you it traded there, and you still have that aggressive buying taking place. It's taking place over a couple bars. Okay, here, buying, went up. Selling. Okay. Yeah, I'd be looking to get short, but again, remember, this is how this chart here played out. It started to go down, and you sort of ran into two buying imbalances over the same levels. But again, take it in context with what's happening in the market. Just because you got sort of two signs here, market did start to go down, but it reversed with the aggressive buying coming in here. So even if you weren't stopped out at these levels, because your stop would sort of be right behind these buying imbalance, these selling imbalances. If you can watch what's happening in the order flow, right? Delta's weakening, minus 200, minus 141, minus 45, minus 24, to positive 227. That's not a good sign if you're short, right? You'd want to see negative delta, negative delta, negative delta. Not all of a sudden smaller negative, and then positive. You could get out in here for a smaller loss than getting stopped out. But again, don't think that it's automatic, take it to the bank and mortgage the house. Every time you see it, trade it. You still got to read what's happening in the order flow. Now, point of control. Point of control on a bar's in order flow analysis provides very valuable information. It indicates fair value in a sense, in a very broad general sense. The point of control marks the price where most volume traded during that bar's time frame. It represents where buyers and sellers agreed on, quote, fair value, unquote. Watching point of control shifts in a bar is insightful. So point of control at the top of green candles, the bottom red candles, shows that volume is migrating through the bar. What that means is you want to see volume migrating in a bar for a trending move, right? If price stays at the bottom of a green bar, it indicates support. If point of control stays at the top of red bars, it indicates resistance. But what about when price is migrating through the bar, right? It's often a good sign of trends developing, right? Oftentimes point of controls are going to be in the middle of the bars, or more or less around the middle. But when you see the long bar with point of control at the bottom, market's looking for liquidity, right? Up at the top of the bar, it's indicating resistance. That's a red candle. But if it's at the bottom of a red candle, it's indicating that it's migrating lower. Volume is moving lower. That's a nice sign for a trending market coming in. And later in the trade setups and strategies, I'll be talking about these migrating point of controls and how you can take advantage of them, right? Point of control is migrating higher in the bar, right? It's coming in near the top of these green candles. Then it's in the middle as the market goes sideways, right? Sort of towards the upper end, but then in the middle at the bottom of the green candle. So I know there's some support coming in here, sort of in the middle. But the signs here early that volume was migrating higher. It's telling you that this market is looking transact more at higher prices, right? Any clue you can get that the market is looking to transact more volume at higher prices, go for it. Take those trades. Now, there are some disadvantages of footprint charts, right? There's setup complexity, which is basically coming down to properly setting up and configuring the footprint chart. It requires some time and effort, right? To find sort of your best template, so to speak, that you want to look at in the market. So traders need to define the specific parameters and rules based on their trading strategies, which may involve a learning curve and experimentation. And there's continuous learning, right? Mastering order flow or mastering a footprint chart analysis is an ongoing process that requires continuous learning and adaptation. And it doesn't just go for a footprint. It goes in trading in general. You never reach like a level. You never find the end. This is it. I know everything. No, you always need to constantly improve yourself. Doctors keep going to workshops and conferences. They get the great conferences, they go to Hawaii and stuff like that, but, they're always improving their skills. So traders should invest time and understanding to see different patterns, interpreting price volume interactions, and refining their approach to effectively utilize this tool, right? This tool is the footprint chart. So reading the story in a footprint chart involves interpreting market dynamics based on factual observations. By analyzing volume, delta, price changes, and liquidity, traders can form a clear understanding of the market's narrative. This allows for better decision-making and pattern recognition over time. So this concludes Module 2. In Module 3, I'll discuss advanced order flow concepts. So I'll see you there.